Good afternoon, everyone. I am Keshav Singla, today's session moderator. Welcome you all to today's webinar on alternative investment funds. Key highlights of today's webinar are legal foundations of AIF structuring, regulatory framework and compliances, practical structure issues, emerging trends in AIF ecosystems. At first, I would like to acknowledge and thank our webinar organizer, CA Dr. Raj Chawla, who provides such an amazing platform where we get knowledge across different disciplinaries. With this, I would request CA Dr. Raj Chawla to give opening remarks to start the webinar.
Do you want me to pull out any other documents? Thank you, Keshav. Good afternoon, everyone. First of all, I welcome all of you in this today webinar on alternative investment fund in India. And today we are very honored that CA Anita Jain ji will discuss the legal foundation of AIF structuring, regulatory framework and compliance, practical structuring issues, emerging trends in AIF ecosystem, and brief overview of International Financial Center, India Fund Management Business, and other IFSC fund management business. So if you have any query, you can raise your query in this our Q&A, or you can ask directly to our faculty. Otherwise, after the celebration of our guest speaker, she will take up all of your queries. So with this, once again, I welcome you all. Over to Keshav.
It's my pleasure to introduce our esteemed speaker for today's session, Advocate Anita Jain, ma'am, founding partner of Equitas Law Partners. She is a highly regarded expert in the area of investment funds, asset management, and regulatory practice. She advises fund managers, institutional investors, and financial intermediaries on structuring, formation, and operation in the wide range of investment vehicles, including AIFs, PMS, and advisory platforms. She is also well known for her work in regulatory structure and enforcement and represent clients before SBI and IFSCA in inspection proceedings and settlements. Now I invite Advocate Anita Jain ma'am to begin the webinar. Ma'am, you can start the webinar.
Sure, Keshav. I think there was some network lag. We missed you for last 10 seconds. But thank you so much, Keshav. Thank you, Rachi, for inviting me for this session. And thank you for all the participants who've joined so far. I mean, it's been pleasure to be here, and at least try and talk in the next 1 hour about what is an AIF, what kind of structures are there in AIF, and what do we advise when, as lawyers, what kind of a recommendation we give to any fund manager who wants to set up an AIF, right? So we'll try to make this session not very theoretical, but rather more practical, right? And I wish I was a CA, but for the benefit of everyone, I'm a lawyer. And yes, I recently qualified my UK solicitor exams. But yes, in terms of my qualification, I'm just an Indian qualified lawyer as of now. Okay. Moving on, I'll just quickly display the presentation. We'll go with the basic, then we'll go into the nitty gritties. And maybe the last half an hour or 20 minutes, we can take the questions, and these questions could need not be like just regulatory or legal. It could also be something more that what kind of a role chartered accountants or any other professional qualifiers can play in this ecosystem, right? Which is very booming and which we've seen in last 5 years. It has grown multifold, be it with SEBI or be it in GIFT City as well, right? So happy to give you some insight. I've been doing asset management law practice for about 13 years now. Have seen the journey from 2012 until 2026, right? And 2012 was the first time when the AIF regulations were introduced. So I'll be happy to also give you some more insights if you all want to know how this industry has evolved in last 14 years. I'll just display my presentation. Is the presentation visible to everyone?
Yes, ma'am, your presentation is visible.
Okay, great. So just to go to the basic, what is an AIF? Okay, AIF is basically an investment vehicle wherein the money from the investors are pooled together, put in one investment vehicle, which could be in the form of trust, company, or LLP. Okay, and this structure where the money is pooled in, it is regulated by SEBI under a specific regulation which is called as SEBI Alternatives Investment Fund Regulation 2012. So the regulations were introduced first in the year 2012. It's been 14 years, and in last 14 years, we've seen substantial evolution even in the regulatory framework. Okay, so just in a basic nomenclature, what is an AIF? It's basically a pooled vehicle. And when I say pooled vehicles, basically you cannot have an AIF for one investor, right? Because the money is pooled together with multiple investors. And when I say investors, it could be basically from Indian shore, basically your resident Indians could be investors, or even a foreign investor, okay, based in any country which is FATF compliant, right? It can invest into an AIF without any RBI approval or without any foreign regulators approval, okay? Because investment into an AIF falls under automatic route, okay? So broadly to say, AIF is nothing but a pooled investment vehicle, just like your mutual fund, how it is there. This is a pooled investment vehicle more for a sophisticated investors, right? And when I say that it's an investment vehicle, it needs to have a defined investment objective. Basically, as a fund manager, I cannot create an investment vehicle without defining a particular strategy. Now, those strategies could be multifold, right? As we go ahead in the presentation, we will also discuss what kind of strategies are there, how each strategy is regulated by the regulator. So, moving ahead beyond the definition, now AIF in India basically can be formed into three structures. One, that it could be a trust, which is then regulated by Indian Trust Act. Then you have a structure called company, that you can create a company which can be an AIF, and the money will come into that company from investors and then further invested into various investment opportunity. The third structuring option what we have is a limited liability partnership. Now, limited liability partnership again will also be regulated by, will be covered and regulated under Limited Liability Partnership Act 2008. So when we create these structures in any of this form, then we have two regulations which are mostly covering this whole structure, right? If it is a trust, then you have Indian Trust Act and also SEBI AIF regulation, which is Alternative Investment Fund regulation. So there are two major regulations for each structure whenever we structure an AIF, right? Now, today in the Indian ecosystem, 98% of the AIFs are in the form of trust. Now, there are various reasons to it that why an AIF is better in the form of trust as compared to company or LLP. Now, one of the reason is, of course, the trust, the compliances under Trust Act are very limited as compared to the Companies Act or an LLP Act. So, trust structure is more, I would say, less compliance onerous as compared to your LLP and the company structure. The second flexibility, which we have it from a regulatory standpoint. Now, AIF as a investment vehicle, you can do multiple AIFs depending upon the strategy. Basically, you could do one AIF for, let's say, real estate strategy. You could do second AIF for debt strategy. You could do third AIF like a sector agnostic fund. So if you do trust structure, it is like an umbrella structure. Under trust structure, I could do multiple funds with a less regulatory coordination with SEBI as compared to company and LLP. LLP doesn't have a concept where I can do multiple LLPs under one LLP, but that's the flexibility you have it under trust structure, right? Similarly, under Companies Act, right, I can't do like multiple companies under one company, but in trust, I can do multiple trust as a sub trust under the main trust, right? So most of the fund managers in India, in fact, all the mutual fund business is mutual funds you see are in the form of trust. So similarly, in the AIF also, the AIF is always 97% of the time is in the form of trust. Okay. Now, going ahead in the presentation, we will always talk about the trust because maximum AIFs in India are set up in the form of trust. Okay. Keshav, just feel free, audience, to you can take the questions in between also. We did not take questions at the end. If they have any conceptual doubts, they can put it on the chat box, and maybe, we can take a pause on that slide and then go ahead the next slide.
Sure, ma'am.
So yeah, as I said, right, that 98% of the AIFs are generally in the form of trust. We are going to focus that how a trust can be set up. What are the regulatory restrictions around the trust? What all obligations we have to do when it comes to SEBI application and all, right? So this is the slide where we talk about these are the parties which are involved when you have to do an AIF business. Okay, it's just not that you created an AIF and with SEBI everything is done. No, the first part of the structuring is conceptualizing the purpose of the trust. Okay, so in an entire AIF setting up business, entire AIF registration, the first discussion we have is what the AIF should be in what form. Should it be in the form of company, LLP, or trust? Once we have finalized that it is going to be in a trust structure, the first step, what we discuss about the trust is the parties which will be involved, right? As we all know, the trust is settled under the Indian Trust Act, right? So there are two major parties when we talk about Indian Trust Act. One is the author of the trust, which is the settler of the trust, and the trustee who's going to be acting as a trustee to the AIF, right? Now, settler can be any Indian resident, individual, or an entity who can act as a settler to the trust. And once the trust is settled, the requirement of AIF regulation is basically to ensure this trust is registered with the sub registrar as per the Indian Registration Act, right? So we cannot just execute the trust deed and go ahead and do an AIF application. We need to get the trust settled, get it registered with the sub registrar, obtain a PAN, and then proceed ahead with the AIF application. So as I said, the first step is to identify the settler. Now, who could be settler? Any individual, company, any of your existing company that could be a settler. What we all need to ensure that the constitutive documents of the company provides an ability to act as a settler to that AIF trust, right? So these are some of the nuances one should keep in mind before even thinking to act as a settler to a trust, right? If it is in the if it is a company which is going to act as a settler, we need to ensure that the constitutive documents of the settler allows the entity to act as a settler to the trust, which is going to be in future an AIF. Okay. Now, who are trustees? Trustees, again, from a SEBI standpoint, could be any company, okay, who is into the trusteeship business, right? Now, trustee today in the AIF ecosystem are generally third-party service providers. You see all the banks like Axis Bank and all, they all have trusteeship business also, just like the banks have custodian business. Some of these banks also have a trusteeship business. They would act as a trusteeship service providers, right? So there are professional trustees who basically play a role of trusteeship and provides trusteeship service to the AIF. And there are like almost today more than 1,200 to 1,400 AIFs which are registered. We don't even have counts for schemes. These are the funds which are registered, and each fund can have multiple schemes. So today there's no public data to say how many schemes have been launched. But yes, in terms of registrations, we have more than 1,200 AIFs which are registered across various categories. And the entire ecosystems are generally catered by these professional trusteeship service providers. Now, next in the structure are the most important entity is the investment manager entity. Now, investment manager entity is that entity which basically provides or takes the decision.
There is a question.
Yeah.
Do you need separate trust/company or LLP for each particular funds?
No. If it is in the form of trust, we do a main trust settled, and then each time when we do a multiple schemes which are independent AIF, we amend that document and create it under the same trust. So it's an amendment deed which is entered into. But yes, each AIF or each scheme, I would say interchangeably, will have an independent PAN, bank account, and everything. But trust is the main trust is one trust, and then we keep amending that trust deed to include more schemes, more AIFs under that same umbrella. Yes, every time when you launch a scheme, a new AIF under that trust, you have to amend the document and it goes to the sub-registrar for re-registration of that document. And then you apply a PAN for a scheme because your scheme name is included in that AIF.
Another question is, in trust, only expenses are allowed to be reimbursed to trustees. The revenue is limited to reimbursement, right?
No, this is contractual, right? In the trust deed, I would generally not allow trustees to take any more money beyond their expense, and then they also have some trusteeship fee. So trustees also get some annual fee from the trust for providing a trusteeship services. In addition to the expense what they would have incurred, they would also get a professional fee.
Madam, this is Vivek.
Yeah,
Am I
hi.
audible?
Yes, yes, Vivek, you're audible.
Ma'am, how is it? Because I only asked this question. So, in Trust Act 1882, the
Yeah,
trustees under regulation under Section 32, they have been restricted to their extent of their expenditures.
yes, yes,
And in SPVs also, we see the same criteria because SPVs, special purpose vehicles like REITs or InvITs, they are also established like a trust only.
yes,
In such
yes.
scenarios, the trustees are supposed to limit their revenue to the extent of expenditures. So, if we establish a AIF in a way of trust,
Yes.
how the board of trustees and the role of limited and general partners will be different from a regular SPV? That is my question.
No, no, SPV is a different structure, right? It is a company. If you establish an SPV in the form of company, it will be governed by the respective act. Now, trust basically, generally, the trustee's expense is in the form of fee only, right? If you see most of the AIF trust deed, we don't say that you can incur any expense without the knowledge of the investment manager, because ultimately the whole AIF structure is of the investment manager, right? So all the trust deed mostly will have a clause that since this trustees are independent trustees, they are professional service providers, they are entitled to a certain reasonable fee which will be agreed by the settler in hand. Okay, I think more trust act more imposes a responsibility on the trustee that not to basically earn any undue benefit out of the trust, because that impacts their fiduciary. But fees is not something which is contravening the Indian Trust Act in any form.
Okay, thank you.
No worries. So the moving ahead, we were saying that the investment manager is a very important entity in terms of your decision making. Basically, who will take the decision of this entire AIF is the investment manager. Now, investment managers are basically, you could say, someone who is gonna decide where to invest money from the AIF, in which companies we should invest, and what kind of a return should be given to the investors, what should be the fee which should be charged to the investors, right, for managing their money through an AIF. So investment manager is a very important role. It is not that you can just become an investment manager. There are certain criteria under the SEBI AIF regulation for an investment manager to act as an investment manager. So it's not more on entity, but the team of the investment manager. So when I say investment manager, I mean more of an entity who's going to act as an investment manager. Just how in mutual fund business, you have an asset management company who manages the asset of mutual fund. Even in AIF, you have someone who the nomenclature uses investment manager entity. Okay. So investment manager entity again could be the company or LLP. You will have an object of that entity is to provide investment management services to the AIF. Now, in that entity, there is some requirement which SEBI imposes, is more from a perspective that this is an entity. Now, entity cannot just manage the fund, right? There is a key person. There is an investment team member of the investment manager who will manage this money on behalf of investment manager entity. We call that person as key investment team member. Okay. Now, this key investment team member is someone who needs to have a prescribed qualification from as per SEBI prescribed guidelines, and also needs to clear one exam which is called as NISM certification exam for fund managers. Okay. The great news is you guys can actually act as a fund manager because you all are like CA, chartered accountants are like highly qualified people. SEBI recognized them that any chartered accountant who has cleared an NISM certification exam, which is prescribed by NISM along with in collaboration with SEBI, can actually act as a fund manager without even any work experience. So even a newly qualified chartered accountant, if he or she has cleared that NISM certification exam, you can actually act as a fund manager for the AIF. Okay. Previously, which is a year back and all, there was a 5-year experience criteria for a key investment team member. So even a chartered accountant who did not have a 5-year experience criteria couldn't have act as the key investment team member. But now SEBI allows you also to ensure that if you clear an NISM certification exam, and that exam I'm sure is much easier than what journey you guys have completed as a part of your chartered accountancy exam. It's a very simple, it's not as difficult as it could be your CA professional and your exams, right? So
Madam, which number of series NIS exam?
so there is a series C, D, and E. So series C is a combination. Once you clear that series C exam, you can actually act as a investment manager for all categories of AIF.
Okay.
Series 19C.
19C.
Yes. So, and then you have D and E. D is basically if you want to act as a manager for only certain categories of AIF, then that is series D. Series E is basically if you want to be a manager to a public market fund and all, then it could be the one. So there are 3 series. One is consolidated. Once you clear that exam, you can act as a fund manager to any of the AIFs. D and E is focused on a particular strategies. So if I think you all should attempt for C, considering you all have cleared such a difficult exam of the country, series C also would not be very difficult for you all to attempt.
Okay. Thank you.
Okay, and maybe post this webinar, I'm happy to share a link of NISM website where you can find this whole module and the examination pattern and everything about this NISM examination. Okay, so that was the investment manager, where there is a requirement of one key investment team member who needs to meet the qualification criteria. CA, CFA, MBA in finance, all those professionals are qualified to meet the criteria which has been prescribed by the SEBI. And of course, all of them have to clear NISM examination. There is no exemption based on any qualification that NISM exemption is waived or something like that. Okay. Now, the next important role is again the sponsor. Now, sponsor is a very limited role. Basically, sponsor also puts in money in the AIF along with the investors to ensure that it is not investors' money which is just utilized by the fund manager to make investment, but also along with the investors, there is somebody else also who's putting in money to ensure that there is a skin in the game. When I say skin in the game, is basically, it gives investor more confidence that if you put in your own money also along with their money, right? So SEBI has prescribed mandatory requirement for a manager or a sponsor, either of the party can put in this continuing interest requirement, so that when you manage a money, you also have to ensure that even your money is at the hook and it is not just investors' money, right? Now, depending upon the category of AIF, there are skin in the games requirement, right? Maybe as we go ahead in the presentation, we will discuss this little bit in more detail, that if you want to set up an AIF business, then how much skin in the game is required for what kind of a strategy, right? So that's the role of sponsor. Sponsor also has certain roles from a compliance standpoint. Also ensure that there are no conflicts in the fund. So those kind of obligations are put on a sponsor. Otherwise, there's not much of role on sponsor as compared to investment manager. Manager is more regulated than sponsor, but of course, both of them are regulated by SEBI. Now, custodian is somebody who basically takes care of your safekeeping of the securities. Again, these are SEBI registered custodians, which are mandatory to be appointed by the manager for the AIF, right? And this needs to be appointed. You can also appoint custodian once you get approval from SEBI for your AIF business. You don't have to appoint upfront, right? But the parties like trustee, investment manager, sponsor, those all need to be placed in the same before we go to SEBI, right? And custodian, auditor, those all parties can come later point in time where you've already received an approval and before you start operating the business of the AIF. Similarly, RTA is basically someone who helps you investor onboarding and all, right? And they take care of your entire operational part of investor onboarding, coordinating with your investors. Before the AIF units were not required to be mandatorily in a demat form, but now anyways AIF units are issued in a demat form. Previously, RTAs also had an obligation when the AIF units were issued in a physical form to collect the stamp duty on AIF. So issuance of AIF units and any kind of a transfer, it was subject to a stamp duty, very nominal percentage under SEBI AIF regulation. But after the dematerialization move, now this role is played by depositories, and RTA generally helps in the investor onboarding and all. So these are the broad parties involved in an AIF. Merchant banker, again, it is important. So before we go to SEBI, we have to prepare certain offer document, which we call it as private placement memorandum. How you have it in IPO, you have something called prospectus. Here we have a concept called document called private placement memorandum. It's a huge document of almost around 200 to 250 pages. That document is certified by a merchant banker who basically gives a due diligence certificate saying that the document has been prepared in accordance with the SEBI law. Okay. So that was more on the parties involved. Happy to take any few questions if you have on the parties, and then we can move ahead and go into the remaining slides. Should I take it from the chat box or you want to take it?
Ma'am,
ये मर्चेंट बैंकर के जरा रोल को थोड़ा एक्सप्लेन करें.
हाँ, सो मर्चेंट बैंकर का बहुत ही लिमिटेड रोल है. जो हमारे डॉक्यूमेंट्स बनते हैं सेबी के लिए, वन बिग डॉक्यूमेंट इज प्राइवेट प्लेसमेंट मेमोरेंडम विच हैज एवरीथिंग अबाउट द एआईएफ कि एआईएफ की फीस क्या होगी, एआईएफ का एक्सपेंसेस का स्ट्रक्चर क्या होगा, पार्टीज कौन है एआईएफ की स्ट्रैटेजी क्या है, रिस्क फैक्टर्स होते हैं एआईएफ वो डॉक्यूमेंट के अंदर. मर्चेंट बैंक को उस डॉक्यूमेंट को रिव्यू करते हैं एंड एक सर्टिफिकेट देते हैं जो सर्टिफिकेट का फॉर्मेट सेबी ने प्रिस्क्राइब किया है. So basically, they see each and every paragraph of that document to confirm that what the lawyers or what the tax councils have written in the document, वो law के against कुछ नहीं लिखा है ना. So they basically have a role to verify the PPM which is filed to SEBI. The offer document which is filed to the SEBI, वो verify करना उनका काम है. क्योंकि अगर कल उस document में कोई mistake होगी या फिर कोई issue होगा तो पहले SEBI will speak to merchant banker that how did you certify this document when this was written.
ma'am, there was another question. How many AIF entities in India so far? Some major AIF.
Yeah. So I think, as I said, there are more than 1,200. There is a public domain list which is there on SEBI's website, right? All these big banks, ICICI, HDFC, Edelweiss, Axis, Motilal Oswal, everyone has their own AIFs. So there are all, and in fact, some of the global players also have their AIFs, right? Investcorp, Blackstone, everyone. So if you all want to know the number of AIFs which are registered, on SEBI website, there is a space called Recognized Intermediaries Card. There you see all the AIFs which are registered till date, when the registration was received and on which date. The complete database is there on the SEBI website. Maybe I would also be happy to share that link, to Keshav. Keshav, you can circulate that, but it is more than 1,200.
There was another question. When the sponsor and investment managers are different persons?
No, under law, very good question. In fact, a lot of time this question is asked for structure. Under law, there is no requirement for you to have two different entities. One entity can also act as manager and sponsor both. So it's more of the role.
Sorry, I'm cutting in between. I have a different question basically. So what I want to ask is, when both the sponsor and the investment managers are totally different persons, do they continuously have to maintain skin in the game, like you said, or like is it applicable for just one of them?
No. Okay. Under law, both the flexibilities are provided. Either one can provide or both together can provide. Okay. The only thing is both are providing. They need to ensure that each of them provides a minimum of 1 crore, right? As I go ahead, what are the requirements of sponsor continuing interest? I will let you know, right, how much one should contribute. So let me, in fact, take this up now only. When we go ahead, maybe we can go a little fast. So today in the category 1 and category 2, the requirement for sponsor commitment is 2.5% of the amount all raised from the investors or 5 crore, whichever is lower. Okay. So let's say, for example, if you had raised 1,000 crores from investors, then your 2.5% would be calculated on that, or 5 crore. In this case, 5 crore would be lower. Okay. Now this, when I say 5 crore is lower, then technically what could have happened? The manager could have contributed 2.5 crore. The sponsor could have contributed 2.5 crore. Or the other way contribution could be manager can provide 1 crore or sponsor can provide 4 crore. But in any case, either of the entities cannot provide less than 1 CR. Preet, was that helpful?
Preet. Yes, ma'am, that was very helpful. Thank you so much. So basically, it is a joint responsibility plus
joint or individually.
Yeah, individually it is 1 crore and joint they have prescribed specifically.
Yeah, individually not less than 1 crore, and
And not less than
if you are the only one entity is gonna provide, then minimum
Sure.
is 5 crore. The lowest limit is 5 crore.
Okay. And just one more thing, like when a trust is created for
Yeah.
this AI structure, like who will be considered as a sponsor? Like the trustee or the settler, who is considered as the sponsor?
From an AIF regulation perspective, it should be settler, because the sponsor definition under AIF regulation is the person who sets up. So generally, we also say that sponsor entity, whoever is going to act as sponsor entity in future for this AIF business, let that entity be the settler. We don't recommend for an individual person like you and me to act as settler, because every time when the amendment happens, we have to go before the sub registrar, right? And
Yeah.
individuals can have always a limitation of health, of place, we might be traveling and may not be available, right? So it is always good to make an entity as a sponsor, right? A settler, which could be your sponsor entity, so that by way of a board resolution, any person can be authorized to go and sign on behalf of that entity.
Okay, that was very helpful. Thank you, ma'am.
No worries, no worries. Any other question, or we can just move ahead to our next slides and like take again in between discussion. Okay, the next important part is the classifications of AI. Now, there are three broad categories of classification. One is category 1, category 2, category 3. Now, these categorizations have been made more from a strategy perspective. So let's say, for example, I'm a fund manager who's looking, because I have an expertise to manage investors' money, and I know I have an expertise to basically invest in a startup companies, right? Or maybe let's say I'm a fund manager who knows how to track a large cap, small cap, listed stocks, right? I may have a different expertise. And depending upon that, I may first decide on what strategy my AIF should adopt, right? So if let's say you're adopting a strategy which is more focused on startup space, or more going to be investing into unlisted securities, right? Then for you, the suitable category would be category 1 or category 2, right? Category 1 and category 2 from a lot of perspective, from a regulatory perspective, from a taxation, I'm sure you all are expert. They have a similar status, right? Only thing is, the limited point is that the registration fee with SEBI is a little different. And in category 1, there are a little bit of a more specific restrictions in terms of your unlisted exposure. But in a category 2 is the most suitable category. So today, even if you see from a market standpoint, right, a lot of these managers would have registered in a category 2 space. So when I say there are more than 1200 registrations, I think almost 34, more than 35%, I think it should be in a category 2 space, right? And why category 2 space works really well? Because from an investment allocation perspective, which is your strategy, up to like more than 50%, you have to invest in unlisted securities, but up to 49.9 is something which you can invest in listed also. So this is the category of an AIF which actually permits you to hold both listed and unlisted in a almost equal proportion, not equal, but more than like equal, right? And in category 1, generally you would have all those strategies where, up to 75% you're going to be investing into unlisted, right? So if at all you want to do 35% of listed, then category 1 doesn't really make most suitable one. And then if you want to do startup, then of course category 1 also works really well for you, right? So if you see in market, most of the AIS would also be in the category 2 space. Some of them, like, if they want to keep a broader flexibility between listed and unlisted. Now in category 3 is a category where you can take derivatives, you can do hedging, you can do commodities, right? But in Cat 1 and Cat 2, you cannot do derivatives. So if at all you are a fund manager who's looking to set up a product which is going to invest into derivative markets, then you can't do under Cat 1 and Cat 2. You have to do it under Cat 3. So these are the three broad classifications on AI. So whenever you think of structuring, you will also see most of the times the legal counsel, the tax counsels will ask you that which category of AIF you want to do, and then we discuss about the strategy, and then we finalize the category. So depending upon your strategy, that is how we finalize on your the category of an AIF. The application process with SEBI, whole trust act, everything all remains the same. It is more about the regulatory restrictions which are there under the AIF regulation. And when I say regulatory restrictions, they are more in terms of investment restrictions and all. Those vary from category to category, but the entire SEBI approval process and application process across categories remain constant. So that was more on the category. Maybe we can go ahead and discuss some of the key documents now. Now, what are the fundamental constitutive documents for an AIF, right? If we are in the form of trust, just like you for companies, you have memorandum of association, article of association. Now, AIF, you have a trust deed because it is a trust, right? That is one document which we generally call as mother document. And then we have something called private placement memorandum, which is like your offer document. Like in mutual fund, if you guys have noted, there's something called scheme information document, which we call it SID, right? Similarly, in your AIF product, we have something called private placement memorandum. Now, why it is called as private placement memorandum? Because AIF cannot be marketed publicly. Okay, this is a product for sophisticated investors. It has to be marketed on a private placement basis. That means that one fine day somebody cannot just do a public announcement on any like portal saying that I'm open for subscription for my AIF. It will not work like that. Okay, how you have an IPO subscription open everywhere on all the apps here and there, the AIF doesn't get marketed that way because SEBI is very clear that this product is for high net worth individual, for sophisticated investors, where minimum ticket size is 1 crore, right? It needs to be marketed on a private placement basis. So that document is called as private placement memorandum. Then you also have like a document called as contribution agreement, which is basically any investor who will invest into AIF will enter into an agreement with the AIF, and that agreement is called as contribution agreement. In mutual fund, we don't have contribution agreement. All of us do online just purchase of mutual fund units, or if you do in a physical form, you have something called transaction slips, right? But in AIF, it doesn't work like that. In AIF, since it's a very sophisticated product, right? There are certain clauses, there are certain undertaking representations which the manager gives, which the investors give, and hence that document is a big document, a little lengthy document, and we call it as contribution agreement. You could also call it as subscription agreement, right? And then there's one more agreement called as investment management agreement. Now, what is investment management agreement? Because when the trust was settled, it was settler and trustee who decided to settle the trust. Now, trustee is not someone who knows how to take decision on investments, right? They are just a trusteeship providers who will take care of the operational administration part. Now, trustee is one who says that, okay, I can't take investment decision, right? There is somebody who's an expert to take investment decision, and hence I'm going to delegate certain investment related powers, certain decision making related powers to the investment manager entity. Now, that agreement is called as investment management agreement. Okay, so these are the four major documents which are generally there in the AIF structure. One is the trust deed, which is the first document. The second document generally in the series is investment management agreement, because trustee gives all the power to the investment manager. And the third document, which goes to the SEBI also, is a private placement memorandum. Now, with SEBI, out of this four, only two document goes, which is your trust deed. And when I say trust deed, it is a registered trust deed. And then there's a document which is private placement memorandum along with a merchant banker certificate. And of course, there are certain declarations, application form. But in terms of major document, right, these are the two major document which goes with SEBI along with merchant banker certificate. So these are four big, very important document which you should be aware if you are into an AIF business. And when I say you should be aware, be it in any role you are, right? If you are a finance person, if you're a legal person, if you're an operational person, these are fundamental documents which you should be aware, because these documents have product related information, right? If you're a salesperson, these documents are also important for you to know what is this product about, what are the features of this product. Everything is recorded in this document. This was a examination related. I think one of the question was on examination. It's there on the slide, right? Which is there. And then general infrastructure related thing, we have basic infrastructure. We have also seen SEBI giving approvals in a WeWork space, right? And the third column is on the continuing interest requirement, which is basically for a category 1. Angel fund is a different category. I mean, angel fund is basically a feature of a fund which only invests into startup. Okay. Cat 1 and Cat 2, basically, angel fund is also a subcategory of Cat 1. And overall, Cat 1 and Cat 2 have a limit of 2.5% of the corpus. Corpus, as I mentioned in the previous slide, it is all the commitments what you have raised from investor is called as corpus. So 2.5% of the corpus of INR 5 crore, whichever is lower. And for category 3, basically, it is 5% of the corpus or INR 10 crore, whichever is lower. Again, the corpus definition still remains the same. It is all the commitments what you've raised. And when I say commitment, don't confuse it with the cash. Okay, commitment is somebody agreeing to give me contribution, right? Today, somebody is giving me an undertaking that I will honor and capital call of X amount. How you have it in share capital also, right? This is a capital commitment. And then as and when you need money, you will draw down that money. So basically, I can give you a commitment of, let's say, 5 CR, but I may not give you a 5 CR cash upfront. Okay. That 5 CR commitment will be drawn by the manager in terms of capital call as and when the money is needed. So commitment, don't confuse with cash. It is not cash. Commitment is basically an obligation undertaken by investor to give me money as and when I call the money by the fund manager. Okay.
Ma'am, I have a question. Can I ask?
Sure.
Sorry. So basically, when we say that they have to continuously maintain this, so when there are profits, like in the, let's say, second year, third year, etc., and the valuations rise, and there is a profit that goes into the account, so the corpus actually grows in that sense. So when we say that we have to maintain that 2.5% of the corpus, will that corpus amount also include the profits that have generated over the years, or it will remain the initial commitment that was made?
No. I think it's a very good question. Corpus definition doesn't change, right? But yes, when we see the skin in the game, right, we also link it to asset under management. See, you would have invested 100 crore, right? But that 100 crore would have become 1000 crore.
Yes.
Right? So when you say the intent of SEBI is, while the drafting says corpus, but from a spirit standpoint, what we do is that you ensure that your skin or your interest, your beneficial interest in the fund can never go below 2.5%. Okay. And when we calculate with 5 crore, when we say 5 crore is the lower, like let's say, for example, on day one, you had raised a corpus of 500 crore. Now your 5 crore was the lower, right? In terms of your limit. So then we say that any appreciation on this 5 crore, ideally you should not take.
Okay.
Okay, because you've not maintained 2.5. Right?
Okay.
So you should not pull down, because if you pull any money out of it from that appreciation, then you will go below 2.5 also, right? So we say that if you've maintained the lowest at day one, right, then don't pull any distributions also out. Let it be in the fund. Let it grow. And once you've paid at the investors, take it at the end when the fund is, exiting all its investment and it is winding up. But let's say if you had maintained 2.5, then it will grow as it grows for other investors also.
Yes.
Right? And then you keep maintaining 2.5. So if the investors have taken out a little bit of money, then you will also be able to take out a little bit of money, because then your 2.5% moves along with your investors' appreciation also.
Okay.
And see, generally, this really doesn't have much of structural issue in Cat 1 and Cat 2, because in Cat 1 and Cat 2, they are close-ended funds.
Yeah.
Okay. In category 3, this becomes very important because market movement happens a lot. You see NAV every day, right? And then the investors can redeem in between in an open-ended fund. But in Cat 1 and Cat 2, it's not an issue. I think there's one more very interesting question on the screen about how the Big Four plays for AI. I think Big Four plays an absolutely amazing role. They help in structuring from a taxation standpoint, who should hold, which should be manager entity, what should be the sponsor entity, whether the manager entity should be LLP or a company, right? And the entire taxation of AIF, because AIF also has a special tax regime under Income Tax Act, right? Similar to mutual fund, even AIF have pass-through status, at least for category 1 and category 2, right? So they play a very big role in terms of advising on the structure, right? While we play a role on the regulatory part and the compliance part of it. But yes, Big Four plays a role both also on the audit side of it. Some of the Big Fours also does a health checkup for the AIF, whether they are in line with all the applicable regulatory provisions or not. So Big Four has an equal important role to play, just like a lawyer, right? Because for any business, the tax considerations are very important, right? From a structuring standpoint. So yes, that's on the role of Big Four. And in fact, A lot of big fours are having this financial service practice as a dedicated practice area where they advise AIF, where they advise M&A structured deals, and then they advise SEBI intermediaries across intermediaries, not just AIF, but portfolio managers, investment advisors, research analysts. So yeah, Big Four does play a lot of role from a structuring standpoint. And they also help you structure funds where you are getting money from overseas geography, from US, UK. So sometimes we also do structure there and then it comes into AIF, right? Maybe not necessarily all investors will come directly into AIF. You may also have one more AIF outside India and the money gets pooled there. All the investors come in that AIF and then this AIF, outside AIF, which is set up maybe in US and any other country, will then invest into India AIF. So then Big Four also plays that which jurisdiction is better from a tax treaty standpoint, right? So yeah, there's a very huge role for Big Fours to play in the financial service space, and AIF is one big ecosystem in the financial service space. Okay, going on to the next part of it is, right, this is the slide which talks about in brief about the process, right? We discussed, first identifying of the settlor, trustee, manager, sponsor. Then we go to sub-registrar, get your trust deed register, apply for the PAN because the PAN is mandatory for you to even proceed with the AIF registration with SEBI. Okay. Once your documentation and everything is ready, which is your PPM, trust deed, and your merchant banker certificate, there's something called SEBI portal. This portal is called as SEBI Intermediary Portal. It is an online portal on SEBI's website. All major registrations with SEBI only happens on this portal, in fact. So we have to go and create a credential for our client. We create a login ID credential. The client has to pay an SEBI application fee of 1 lakh plus GST. Okay. So it's an online portal. Once you create a login ID, after you have received your PAN, you go and on the basis of your PAN, you create a credential on the SEBI website. Now, once you've paid that application fee, SEBI within 24 to 36 hours, once the payment is verified, they send you a link to your login ID. So it's basically that is like a portal where a limited access is given. The fund managers or the lawyers could have access to that portal. And when we have to upload this application, we upload this application on that portal. Okay. So the entire application is submitted on the portal, and from that portal, it gets allocated to SEBI officer. Okay. And once the SEBI officer is allocated, then they can raise queries on our application, on our documents, if they need some more information. Generally, these queries are sent over an email and then we reply over an email. Sometimes these queries may also be raised on the portal. Okay. Once all the queries are resolved, then SEBI issues a certificate to the AIF, which is called a SEBI registration certificate. So generally, this whole process with SEBI takes around 3 months, right? They would have multiple rounds of queries. And once we respond those queries and they are satisfied with all the requirements, they issue a certificate. Now, the certificate is a perpetual certificate. It basically, you decide in your fund document how long you want to run this AIF in terms of your strategy. It could be 8 years, 10 years, 12 years. And there is no renewal fee, but yeah, there is a registration fee. Okay. Each category 1, 2, 3 have a registration fee. 1 has 5 lakh plus GST, 2 has 10 lakh plus GST, and category 3 fund has a 15 lakh plus GST as a registration fee. Application fee remains the same, right? You pay a registration fee once SEBI confirms that you are eligible to receive an approval. It will give you an approval, and then you pay the fee, and then SEBI issues the certificate. Now, there's no renewal fee after that for AIF. It is a perpetual license. You can launch multiple schemes under that AIF, and each scheme filing fee is then 1 lakh only. So registration fee is like a one-time registration fee. And these are some of the key regulatory restrictions which one should know when they are planning to do an AIF business. The first one being is initial closing. What is initial closing? Basically, SEBI has now given you an approval on your PPM, okay, saying that your product is a good fit to launch. You can go ahead and launch. SEBI expects you to launch your product within 1 year, okay. And when I say launch, that means you should start. Basically, you should have collected the money from investors and you should have started making the investments. Okay. So basically, it's like more of a commencement of business, right? If you don't do it within 1 year, then your PPM, which was reviewed by SEBI, that lapses. The registration doesn't lapses. It is only the PPM which was approved by SEBI as a part of your registration application that lapses, and you have to refile your PPM. And then again, you have a 12-month validity, right? Refiling of a PPM is not like 10, 15 lakh, 5 lakh cost. It is just a 1 lakh rupee cost again, which the clients incur, right? Now, it is not that today you've received an approval from SEBI, you can launch next day. No, there are certain conditions for your launch. When I say launch, basically before you start commencing the investment activities for the AIF, right? One of the most critical conditions is you can't start just your AIF business with 1 crore commitment. That means that you just received one investor and you started the AIF. That's not permissible. You need to at least ensure that you've raised a commitment of 20 CR from investors. Okay, 20 CRs, that could be meaning that you have 20 investors who are contributing, each one of us agreeing to contribute 1 crore each. Or you could have 4 investors where each one of them is agreeing to contribute like 5 crore. So if you can have 2 investors who is willing to contribute 10 crore. But what SEBI expects you to ensure that you cannot start your AIF business until and unless you've received a total commitment of 20 CR from investors. Okay. Once you get investors' commitment, then of course you also add up to your commitment to that corpus, right? Because that is what your sponsor continuing interest is. If you've not received 20 crore, you cannot launch the fund. And if your PPM lapses, you have to refile it. So that's something very important before you start commencing your AIF business. Now, so no minimum corpus required for angel fund. Angel fund is a specific feature of a product where you only invest in startups, right? But for any other categories of AIF, you have a minimum corpus requirement of 20 crore. Now, what are the ticket size? Minimum ticket size for any investor is 1 CR. But if let's say husband and wife together were investing, then together they can invest 1 CR. There are few relationships which SEBI has agreed for joint investor, husband, wife, one of them, then father, son, father, daughter, like, so those are also covered under the joint investor relationship, where together they can contribute 1 CR. When I say together they contribute 1 CR, that means each of them has to contribute at least something. It could be 99 lakh, 1 lakh, it could be 80 lakh, 20 lakh, but both the investors have to contribute some little amount, okay? There are certain relaxations. If you are an employee of an investment manager entity, or if at all you are a director or a designated partner of the investment manager entity, then SEBI tells you that even you can invest minimum of 25 lakh. You don't have to invest 1 crore. So there are special relaxation for the team members, for the directors of investment manager entity. The new regime, which is basically, let's say if you're an accredited investors. Now, accredited investors is a very recent, not very recent, but a 2-year back concept which was introduced by SEBI across all intermediaries, right? And when I say across all intermediaries, it's more of a investor who are sophisticated and they are certified by an agency that they are sophisticated. There are certain net worth criteria, your income criteria. If you're meeting that, you can go to the accreditation agencies. They will give you a certificate. And if you hold that certificate, then you can in fact invest as minimum as 5 lakh also in an AIF product. Then a ticket size of 1 crore is not mandatory. Okay. So that is the benefit if you're an accredited investor. Now, the tenure of the AIF means that once you decide to launch an AIF, you have to at least ensure that you are continuing the AIF business for at least a particular minimum tenure. Now, this minimum tenure is more of a relevant concept in a category 2 and category 1 because those are close-ended AIF. They need to at least have a minimum tenure, and minimum tenure is 3 years. This 3 years is basically calculated from the date when you announce the initial closing. Okay. Initial closing is generally a first closing. When you decided to onboard the investors, you have received the minimum of 20 crores, right? Now that outer cap is 12 months. Within 12 months, you have to announce after SEBI approval. But let's say within 1 week of SEBI approval, you've received 20 crore commitment, then you can say my initial closing is already announced. And then your tenure, which is your life of your AIF, is calculated from that. So when I was talking about private placement memorandum, basically you include in that private placement memorandum what will be the tenure of that AIF, so that your investors are aware how long you're gonna keep our money invested. So that could be 7 years, 8 years. We've generally seen a trend of 5 to 8 years as a product life. Now there's something called extension of tenure also under AIF regulation. Let's say, for example, when you raise the money, you thought that my strategy will require investors to hold their money for at least 5 years. But after 5 years, there is an economic slowdown, market is volatile, you are not able to exit the money from the portfolio company. SEBI does allow you to extend your tenure by 2 years, which is by investor consent. Okay. So if 2/3 investor by value in the fund allows you to extend the tenure of the AIF for up to 2 years, it is permissible. Beyond 2 years, even if investors agree to extend, you cannot extend the AIF tenure. Okay. So that's an outer cap. Now, category 3 is a little bit different strategy in that you, as I said in my previous slides, that you could also do derivatives in category 3. So it is more a little bit more riskier product, I would say, not otherwise, but because of the strategy, right? Because basically SEBI says that if you're doing a complex trading strategy, then you should come and do it under Cat 3. When I say complex, it could be hedging, it could be derivatives, it could be leverage. SEBI allows you to take leverage only under this category, right? Some of the differences are in this is that you can only launch open-ended fund under this category. You can't do under Cat 1, Cat 2 an open-ended fund. In category 3, you can do open-ended fund. In this category, the sponsor continuing interest is little higher as compared to 1 and 2. Okay. As I said in my previous slide, in 1 and 2, the limit is 2.5% of the corpus or 5 crore, whichever is lower. But in Cat 3, it is 5% of the corpus or 10 crore, whichever is lower. Otherwise, the same restrictions apply that the corpus has to be minimum 20 crore. If it is a close-ended Cat 3, then minimum 3 years of tenure. Extension timelines are also same. The investor ticket size, which is 1 crore, is also same. The only difference here that if you're doing an open-ended category 3, what does an open-ended fund mean? That investor can come anytime as per your contractual discretion, right? You could have dealing day. How today in mutual fund we can invest every day, right? Generally in AIF, a lot of fund managers could keep a dealing day of a monthly basis. That means in a particular month, they will open a window for investors to invest. Okay. So open-ended fund, generally the dealing days are mostly on a monthly basis. Some managers can do weekly basis, daily basis, but because it's a 1 crore ticket size, you don't see investors coming every day, right? So mostly the fund houses will keep a dealing day of monthly basis. And the redemptions are also allowed in a category 3 AIF. If it is an open-ended fund, generally the fund managers would offer redemption on a monthly basis or on a quarterly basis, right? So that's the feature of a category 3 open-ended. The people can come and go as per the terms what the investment manager is offering. Now, only if it is an open-ended fund, you have to ensure that every investor, the first tranche of cash in the fund gives you a minimum 1 crore rupees. Unlike in category 1 and 2, where it is a commitment which is given as 1 CR, and then manager, as and when it needs money, it can draw in a tranche of 10 lakh, 5 lakh, 20 lakh, whatever is the need of the investment strategy. But in a category 3 open-ended, any investor who decides to participate in an open-ended fund needs to ensure that the first cash which will be contributed in the fund cannot be less than 1 crore. So that was broadly on a category 3 AIF. I think this slide, which is on the statutory fee, which I broadly covered, is 5 lakh. Angel fund is a special product, the fees is less. But otherwise, category 3, it is 15 lakh plus 18%. And your category 2, it is 10 lakh plus 18% GST. Any specific questions if you all have so far, I'm happy to cover that. Or else we can go ahead on the major investment restrictions.
Can you elaborate more on the, this is a statutory fee. I just wanted to know, how much do legal firms and other partners charge?
I mean, that is little bit very subjective question. The more experienced lawyers, the more experienced firm, the fees could be in the range of some amount, but someone who's just starting up may charge little lesser. But at least my suggestion would be, if you know your friends or anyone who's going to start an AIF business, it is always to go with the expert, because it's a very customized product and the regulatory provisions are very wide and comprehensive. So it is better to go with lawyers who have been in the industry for many years and who understands the SEBI requirement, right? So, Preet, honestly, the fees would vary depending upon the firm you are approaching and depending upon the lawyer. It all vary. It all varies.
So, like a 100 crore category 2 fund, how much would it cost to just set up?
See, setup, as I said, the regulatory registration fees I already discussed.
Yeah.
Right? Indicatively, you should see a cost of 25 to 30 lakh. This I'm trying to give you an average cost, 30
Average cost.
rupees,
Okay.
which would include tax council's fees, legal counsel fee, and SEBI registration if you are doing a category 2 AIF. This is
Okay.
only
And
the setting up.
this includes the start fees as well, or like this is the other fees that will go into it?
No, the start fee, not the other fee. Other fee is anyways charged to the investors once they come, but
Yeah,
this
yeah.
is the cost incurred at the time of setting up.
Okay. Thank you.
No worries. Okay, coming on to the investment restrictions. Now, there are certain restrictions depending upon what kind of an activity you are carrying, right? Let's say if your AIFs was supposed to invest into a foreign security, venture capital undertakings outside India. Foreign securities, I don't mean that you can invest in all foreign securities. You can only do investments into unlisted securities, which are like venture capital undertakings. Venture capital undertakings, basically, generally, which are newly incorporated entity, which are not listed, right? They have not defined what is venture capital undertaking. But if I had to compare it to Indian system, basically like a startup companies, right? You cannot just invest. You need to go and take SEBI approval even to invest outside India. In India, if you want to invest, you can invest and you don't need, of course, any SEBI approval. Once you've received a registration certificate, you can invest in the portfolio companies, which are your investee, which are your any companies in which you want to invest. Then there's something called co-investment terms. Basically, sometimes it may so happen that there are investors who are not investing through AIF. They have invested some small portion of money through an AIF, but they are also investing outside the AIF directly in the portfolio company. So then those investments are called as co-investments. Now, each of these categories of AIF have certain threshold up to which you can invest in a particular company, right? For category 1 and 2, basically you cannot go more than 25% of your investable fund of the AIF in one portfolio company. Now, what is investable fund basically? Investable fund means whatever corpus you've raised from investors, keeping aside some money for your day-to-day operating expense, then whatever is the money left is where you calculate your 25% limit, right? So in Cat 1 and Cat 2, you cannot go beyond 25%. There is a special product which is called as large value fund. Large value fund is basically a higher sophisticated product where your each investor invests minimum of 70 crore. Okay, so it's in a normal and a very easy explanatory way. If I had to say, a large value is basically a product for a premium investor, right? Who are actually contributing, each investor is contributing 70 crore in the fund, and plus those investors are accredited investors. That means they are either accredited investor as a deemed accredited investor, or they have a certificate from the AI agency. When I say deemed accredited investor, that means there are certain categories of investor who doesn't need a certificate from that AI agency. They will still be treated as a accredited investor. Okay, and these are generally basically, banks, your public financial institutions. They don't have to go and take certificate to claim themselves as accredited investors. So if at all you were doing a product which was supposed to be a large value fund, large value fund is a feature of an AIF. Okay, it's not a different category, rather a specialized product for an investor who's going to invest large value of money, right? So basically, large value is a feature which could be under any category, either under Cat 1, Cat 2, Cat 3, right? But it is a specific product feature. And what is the benefit of a large value fund? That in a normal AIF, where you can invest up to 25% in a large value product, if your AIF is a large value fund, you can actually go up to 50% of your corpus investable fund in an investee company. Then what are the other restrictions? That if I am one AIF, I can actually also invest into another AIF. But if I'm doing that, then I cannot take money from any other AIF. So technically, it means I cannot have a 3-layer structure. Basically, one AIF putting in money into other AIF, and that other AIF further investing into another AIF. That SEBI doesn't permit. So basically, SEBI says either you accept money from one AIF in your own AIF, or you invest into other AIF. So that is what one of the restriction is again. There are certain transactions which SEBI considers as a related party transaction. Those transactions a fund cannot carry unless and until they have taken an investor consent of 75%. Now that is the requirement of law. that certain transactions they consider as a related party transaction. Let's say, for example, to give you an example of one related party transaction was that if an investment manager entity has any group company where it holds more than 50%, 15% or something, right? It is treated as an associate. If your investment manager entity was holding 15% in another company, it is treated as an associate, right? And if your AIF was investing into that group company of investment manager, that is called as an associated transaction. You cannot do unless investors give you a consent for this. Okay. Then SEBI also says that let's say you called money from investors and you still have some time to invest into your investee company, which is your target company in which you will invest, the fund will invest, right? Then SEBI says that until you have utilized that money for investment purpose, you can keep it as a part of your treasury management. You can invest into liquid mutual fund and all those things. So that is something called as temporary investment. That is not your actual investment, but are temporarily deploying your money until you utilize that money for the fund investment. So these are like a category 1 where you can invest money, permitted investments. You can invest in any LLP, any venture capital undertaking, then your units of other AIF, as I said, right? Then AIF can invest into other AIF also. Then there are certain restrictions in terms of borrowing, how much a fund can borrow. There are certain guidelines and limitations. The Cat 1 and Cat 2 fund cannot borrow more than 4 times in a year. Okay. And there is a limit to which it can borrow. It cannot borrow more than 10% of the investable fund from your AIF. What is investable fund? Investable fund is the same principle what we discussed, right? All the commitments what you've raised from investor, keeping certain percentage aside for expenses is how you derive to amount called as investable fund. Investable fund, don't confuse it with the cash. It is not cash. It could be more than cash, because what we are saying, commitments which investors are going to give you in terms of cash later date, but those are commitments. And then from their total commitment, you set aside certain percentage of your expense which you will need for your entire duration of the fund. So if it, let's say for example, it is a 5-year fund, and if you know you will need every year 3% of your corpus, which is all your commitments for expense, then 3 into 5, 15, right? So 15% money you keep it aside, right? And the 85% is then treated as your investable fund, and 10% of that 85%, which is 8.5, is what you can borrow. And same principle, when we were discussing about this 25% limit, is also calculated on the same 85. You calculate your 25% limit in each portfolio company. Similarly, you know, maybe this is one, the Cat 1 and Cat 2 restrictions are same. So if you see the next slide also, it is 4 times per financial year, not going 10% more than investable fund. And then the borrowing, whatever borrowing you're doing, right, it cannot go beyond 30 days. So you have to repay the borrowing within 30 days. In Cat 3, the limits are little higher. It is 10%, lower. It is 10%. So what we had 25% in Cat 1 and Cat 2, it is only 10% in Cat 3. And if it is an LVF, as we saw in our previous slide, that it was 50% if you see on this slide, it was 50% allowed, but in Cat 3, it is only 20% which is allowed. So a normal category and then 2 times. So if it is an LVF, in a Cat 1, Cat 2, where it is only 25% allowed, if it is not an LVF product, which is large value product, then it is only 25% allowed. But if it is a large value feature, then you can go up to 50% in one portfolio company. Similarly, in Category 3, which is more of a complex trading strategy, you can go up to 20% if it is a large value product. In Category 3, as I said, that you can do derivatives, you can do commodity derivatives, then you can engage in leverage. Leverage has certain limits under SEBI regulation. You cannot leverage beyond 2 times of your NAV. So if you have 100 rupees, you can take an exposure overall together is 200 rupees exposure. Yeah, I think this was on the presentation. Maybe I'll take a pause. And how this was all about SEBI, but let me just take like 5 minutes and tell you, you have exactly a parallel market in GIFT City, right? GIFT City is basically your international financial center. Today in India, there is only one international financial service center, which is in GIFT City, Gandhinagar, right? You have exactly a similar framework for the AIFs which are set up in GIFT City. In this presentation, we only covered the SEBI part of it, but equally comprehensive framework is also there in Gandhinagar, like GIFT City. The regulator there is called as IFSCA, International Financial Service Centers Authority. In domestic, which is India, right, it is called as Securities Exchange Board of India, right? So there is a parallel framework, equally comprehensive in terms of registration, filing, investment restrictions in Gandhinagar, right? So the funds which are set up in India, other than Gandhinagar GIFT City, are governed by SEBI. But any fund which is set up in GIFT City is not governed by SEBI. It is governed by a regulator called as IFSCA, right? So interestingly, for any professional who's looking to enter into an ecosystem, and when I say ecosystem, AIF ecosystem, you all have equal opportunity in the mainland, which is regulated by SEBI, and also in GIFT City, which is regulated by IFSCA, which is IFSCA. So opportunities in terms of your professional career opportunities, you have equally at both the places, right? And very few lawyers, very few CA, they would explore this space because it's a very niche space. But let me tell you, it's a very booming space. I entered when the regulations came back in 2012. There were hardly any AIFs, but if you see in last 10, 12 years, it has grown exponentially. So from a career trajectory, if you're looking at, and one good part about it, if you are into an AIF ecosystem, let me tell you, globally, the process works in a similar manner. So if you worked in an Indian AIF, you can actually work in any AIF set up in Europe. You would see a lot of operational financial modeling globally remains the same standard. And when I say just not tax, you also have a career in valuations and all, right? Globally, most of the AIFs follow your IPV guidelines, which all Indian AIFs also follow. So there's a lot of career opportunities, career prospect, right? And since it's a global framework, right, a lot of these concepts are similar across the globe. So when you see this ecosystem, don't see that your career prospect is just limited to India. If you work 5-10 years in this space, you can actually go and join any PE fund in abroad, right? And there are a lot of funds in Singapore, US, UAE. There is enough of career opportunities when you're working into this ecosystem. Maybe I'll take a pause. Happy to speak to you all, understand if you all want to know anything about this space more.
Ma'am, I do have two questions, but they are more related to AIF regulations themselves.
So sorry. Can you repeat?
I have two questions, but these are related to AIF themselves. Is it okay if I ask them?
Yeah. Please.
So, ma'am, how do you differentiate between a fund and a scheme? What is the nitty-gritty that goes into it?
See, we generally use fund and scheme very interchangeably, but rather you should say, if we had to understand the difference, it is trust and scheme. Okay? Let's say fund and scheme for now. So the main trust, which gets the certificate, is generally we call it as trust or we call it as fund. Okay? And any multiple products which you launch under that trust, because every scheme doesn't have a registration number. Okay? It is the trust which has a registration number. Let me explain, because I'm sure you guys would have invested into mutual funds, so it's easier to understand, right? So you have, let's say, something called ICICI Prudential Mutual Fund. Okay? So SEBI gives registration to ICICI Prudential Mutual Fund, and then SEBI basically acknowledges their product, which is, let's say, ICICI Prudential Balance Advantage Fund, ICICI Prudential Value Discovery Fund, right? So these are schemes. Similarly, in AIF also, you will have a trust, which will be, let's say, named as HDFC Alternate Investment Fund. Okay. Then you will have schemes, HDFC Balance Advantage Scheme, HDFC Multi-Cap, HDFC Public Market Fund. Okay. So that's the difference between the fund scheme, or you could rather say trust scheme. So the SEBI gives registration at a trust level, at a fund level, and the schemes are the products which are filed with SEBI, and the SEBI acknowledges those product approvals.
If I say that, when a fund is registered, they have to give the PPM, right? So in that PPM, if we mention we have to mention the investment strategy and investment objective as well. So when we are specifically mentioning that, can the schemes that come into that fund be like they have to maintain that investment strategy, or
Yeah. If
like
you change any investment strategy, right, you need investor consent. So if you determine that, let's say you're going to invest 60% in unlisted, 30% in so and so,
okay,
then and investors have looked at your investment strategy and they decided to invest, right? Now, if you
okay.
change that, then it's a material change. You should first take investor consent and then only change it. So you need a 2/3 investor consent before you change that strategy.
So basically, strategy is like from your point of perspective, strategy is like when we are allocating like 60%, 30%, 10%,
Yeah,
something
yeah,
like that,
yeah.
and like not specifically like I'll invest in let's say real estate, or I'll invest in let's say health, pharma sector or health sector. So is that investment strategy, or like this 60-30% is
So,
investment?
so strategy is little broad, and these are
Okay.
investment allocations, right? But even if
Okay.
you change allocations, then it is
Yeah.
termed as change in strategy.
So, but like then how can different schemes be within that same fund? So, like I
Okay.
can't understand that
Yeah,
perspective.
I'll tell you that. So category 2 is again, it's a very broad category. Okay.
Yes.
So now
Yeah.
let's say I do first scheme, I will say that I will do only debt investments.
Okay.
But I'll
Okay.
do second scheme, I'll say I'll just focus on healthcare, only on fintech. But
Okay.
so the category is very broad, but you will
Okay.
have specific strategies for your product because see, you can't tell investor I'm doing category 2 AI.
Okay.
Then
Okay. Okay.
investor will say, right, but what in category 2 AI? Which
Yeah. Yeah.
strategy, which sector you are tracking? Those all
Okay.
questions will come. And hence that investment strategy then becomes very important. So see, SEBI has just defined a broad categories,
Okay.
right?
Okay.
With some explanation what kind of a strategy can fall under that. But when you're
Okay.
pitching your product to investor, it needs to be very specific, right? Otherwise, I'm giving you 1 CR. I can't just give you 1
Sure.
CR just because it's a category 2 fund, right? But I want to know your thesis. I want to know your investment thesis, that in which sector you're gonna
Okay.
invest, right?
So, like, basically, when I'm giving out the PPM, I first broadly describe the investment strategy, and then when I'm like introducing new schemes, I go into very specifics of those.
No, when you go with the SEBI for registration,
Yeah.
now with that registration, the PPM what you give, right? That's a
Yeah.
first product PPM which gets approved.
Okay. Okay.
Okay. So that first product PPM will have similar. So, okay, let me also tell you that there is a proper template which SEBI is given for private placement memorandum,
Yes.
which
Yes.
template itself runs into more than 100 pages and which are
Sure.
just guidance note. So we
Sure.
prepare a detailed memorandum basis that. So when you go for a registration, your first product is by default getting approved with that registration.
Okay.
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 When you
Yeah.
want to do a now new scheme, then you prepare a new PPM and then
Yeah.
you file it with SEBI with 1 lakh
Okay.
application fee.
Okay. Okay. And like my next question is like I heard this somewhere because I just wanted to cross check because I couldn't find it written anywhere. Is there any some specific fund where the investors can choose like basically this is the investment that I want to be part of and this is the investment I don't want to be part of?
Yes, that can happen. So basically, what will happen that I will say that okay, let me tell you, I'm a very religious person, if at all, right? And
Yeah,
I don't want to invest in a tobacco company.
yeah, yeah, yeah.
So I will tell investor, listen, but I cannot pick and choose later on, right? Because then I'm being opportunistic. At the
Yeah,
time of onboarding, I will
yeah.
tell the investor will tell me, which is the manager, saying that, listen, if you invest in a tobacco company, I'm not agreeing to invest, right?
Okay.
You may think that your strategy may not have so many tobacco companies, or maybe 1% of your
Yeah.
strategy would be in tobacco company. Then you'll tell investors, okay, fine, you come in my fund, don't worry, my strategy is not focused on tobacco company, but if I see an opportunity, I may want to invest for other investors. Then you will tell investors, okay, you keep yourself aside from that investment, I will not utilize your money to make in that investment. That concept is called as excuse investment, basically.
Okay. Excuse investment.
Yeah.
So basically that has to be incorporated within the contributors agreement, right?
रेडी जी और उन्हें भी किसी ने क्वेश्चन पूछना होगा सारे ही आप पूछोगे
Sorry.
You basically, your investors will tell you at the time of signing of the contribution agreement.
Okay.
Don't invest in so and so sector. I'm not comfortable, and
Sure.
then the manager will excuse.
Thank you.
Additionally, there are provisions in the PPM as well regarding excused investments.
Yes. Those are very broad provisions in the PPM, which basically says on account of internal policy or on account of regulatory restriction, investors can decide not to invest. So for example, if insurance company was investing into AIF, right? Then they will say, listen, we are investing into your AIF, but our money should not be invested to make overseas investment, because they have a restriction under their law.
मैम LLP का जो स्ट्रक्चर है की बजाय कहा जाता है टैक्स एफिशिएंट है, थोड़ा इसको जरा डिफरेंशिएट करेंगे ट्रस्ट का स्ट्रक्चर और LLP का स्ट्रक्चर ये फॉर्मुलेट करने के लिए.
Sorry, efficient in terms of
क्यों डिफरेंस है LLP और ट्रस्ट?
So I was discussing ना कि you can do multiple products under a trust, right? कंपनी और LLP में आपको हमेशा एक नई कंपनी स्टार्ट करनी पड़ेगी for you to do a new product. But in trust structure, you don't have to set up, incorporate, go to MCA again and again. Trust structure में you just amend the trust deed, which is one pager amendment to trust deed. Go to sub registrar, get your amendment registered. So that is why it is more operational ease process.
जो टैक्स पास ऑन का बेनिफिट है वो
AIF तो वो irrespective है, pass through जो है वो whether it is company, LLP or trust, it is still a pass through and it is taxed in the hand of investors. So that position of law, tax law doesn't change whether it is a trust structure or whether is it a company or LLP, because that pass through status is given to AIF. Now AIF can be in any form than trust, company, LLP.
Yeah. So, ma'am, what is the difference between these venture funds and AIFs? Generally, not when I say venture funds means this angel funds. Sorry.
Yeah. So angel fund is one of the subcategories. It was of AI. Like if earlier it was just a different category or a different product. Now it is just like Cat 1 AIF. Now in angel fund there are certain more different investment restrictions. So basically in angel fund you can only invest into companies which are startup. Now startups are defined under a central government notification. Now they are going to change the turnover ratios, but it was earlier saying that which is not incorporated for more than 10 years, not having a turnover of more than 100 crores, right? And I think recently there is a proposed amendment which is going to be made to a startup definition where they are increasing, going to be this 100 to 200 if I'm not wrong. But yeah, angel funds can only invest into startup. But let's say if you were doing a normal Cat 1, which was not as an angel fund, right? Then I could do in any company, not just in startup. Second, in angel fund, the issue is that while the investors had agreed to invest, but every time I make an investment in any company, I have to go back to them, take their consent, and then only invest, which is not required in my category, normal category 1 or 2 or 3, right? Once the investor has given me money, I have discussed the strategy with them at the time of onboarding. Now I do investment in 10 companies, 15 companies. I don't have to go back and take a specific consent. But in angel fund, it is not that. Angel fund, my operational hiccup is this, that every time when I make an investment in any company, I have to first go back to my investor, say that, this is a portfolio company, I'm going to invest. Are you going to be interested in participating? If yes, then they will agree to invest. So that's more of an operational to and fro with investors in angel fund, but in a normal AIF, Cat 2, Cat 3, it is not an issue. Of course, an angel fund registration fee with SEBI is also less. The second thing, in angel fund, the recent framework, this product will only be available for accredited investors. No normal investors will be able to participate in angel funds from 8 September 2026. Okay. And when I say accredited investors, it is like there are certain criteria for you to be considered as an accredited investors. It is a net worth criteria. It should have more than 5 crore net worth, 5 or more crore. Then you have an income criteria, annual income of 2 crore. These criteria meet करने के बाद भी you have to go and take the certificate. You are then going to be treated as accredited investors. And if you're accredited investor, then only you can participate as an investor in angel fund. So these are some of the nuances of angel fund. So at least from our perspective, because we've been tracking this industry for 14 years, angel fund sooner or later may just get, moved away, because the investor participation or ability for investors to participation window is going a little low, right? Because not any normal investor can participate after 8 September 2026. So maybe we see that it may not be even a relevant product stream after some time, right? And mostly then people will do normal Cat 1 and Category 2 funds.
Thank you. And also from a investment perspective, let's say somebody puts in, a minimum investment of 1 crore, as is mentioned by you, maybe in Cat 1 or Cat 2. And is it possible that the trustee or a settler or an investment manager changes the structure of the Cat in terms of, instead of, let's say, when you made the investment in initial time, it was Cat 2. And then maybe 1 year down the line, they change the category from Cat 2 to Cat 3 because they seems that, derivatives seems to be more lucrative in terms of maximizing the returns. So is it possible from a structure perspective that they can change the category to from Cat 2 to Cat 3, or it is completely freezed at the initial stage itself?
No. See, there is a provision, but it's not a very easy process. One, I'll tell you why. That you have to go and take investor consent.
Yeah.
Okay. Now, to take investor consent is a long-run process. Second, you have to go to SEBI and formally make an application to change the structure. Today, we don't have a precedent. We do have a flexibility and provision for change of category of an AIF, but we don't have a precedent because the time, effort, and the cost involved will be equivalent to if you do a new funding.
Thank you. Thank you.
So you have to rerun the entire process. So ideally, the managers never do that. They in fact set up a new fund.
Got it. Yeah. Thank you.
Okay. Any further question?
I think, ma'am, we should end the session.
I hope it was insightful for the people who have joined.
Yes, thank you, ma'am, for having such an insightful and valuable session.
Thank you. Thank you, everyone. Wishing you all a great weekend ahead, and very inspiring that on a Saturday weekend, on a special day, we have so many people who have joined the session. So thank you once again.
बहुत informative रहा.
Thank you, sir. Thank you.
बहुत informative.
Thank you. You all can. I generally put a lot of updates on LinkedIn about any regulatory amendment, so you all can go and like our page on LinkedIn. Or you can
PPT अगर possible हो तो share कर सकते.
Sure. We'll coordinate with Keshav and we'll update a few things here and there and then send a PDF.
Sure.
And you all can also see our law firm website. We are very newly set up law firm. I've worked in industry for some other firms, and then we started very recently in our own firm. So keep a tap on our LinkedIn page because we keep summarizing whatever new notification keeps coming from SEBI in this domain. Okay. So it could be insightful if you're looking to get more insights about this ecosystem.
Sure, ma'am. Recording link will be shared to a registered website, a registered email ID or numbers to members till Monday.
Okay. Thank you so much, everyone.
Okay, thank you.
Thank you so much, ma'am.
Have a great weekend.